Great. I think we've still got a couple of people, but I think we're going to make a start here just to let everybody know. We have got a Q&A feature at the bottom of the screen. So if you've got any questions throughout the webinar, please do add them to the Q&A. We'll try and cover some off at the end, and we'll do our best to answer what comes through. So what we're going to do now is just start off with our webinar. So welcome to the first in our webinar series on the 2026 inheritance tax changes. It's a joint webinar between Prime Accountants and Prime Wealth Planning. Across the series, we're going to cover off IHT framework, pension IHT changes that are coming from April 27, and protecting businesses and family, and so on. Today's session sets the scene. And as said, we've got a Q&A at the bottom, so please do add your questions throughout. So introducing our speakers today, you have myself, Paisley. I am tax director here at Prime. I work throughout the tax compliance team as well as assistant advisory, and I've been within the tax team now probably for around 20 years. If we move on to Andrew, Andrew is our trust and estate specialist. What Andrew doesn't know, then surely nobody knows. He's head of our private client team at Prime. He's a current leading expert in the inheritance tax and trust sector with many articles under his belt, and he's currently writing a book on the topic. And then we have Glenn. Glenn is our financial advisor. He's managing director of Prime Wealth. He's the principal advisor and assists clients with financial planning, advice related to pensions, investments, and the like. So moving on to the agenda for today, there's some key questions that we're going to seek to address, and I'll ask each of our experts to share their thoughts on these topics. In terms of timing, we'll cover off everything we can, and then we'll finish today with a Q&A. So over to you, Andrew.
Thank you, Paisley. When the tax was introduced in 1974, it was introduced as capital transfer tax. At that time, it was a relatively straightforward tax, easy to read, short, and the position now has completely changed in that it's probably not particularly easy to read, not particularly intuitive, and it's much more complex than it was before.
Okay, so what are the key building blocks, Andrew?
Well, we've set down the key building blocks here. The first thing to understand is that transfers between spouses or registered civil partners is unlimited. So that's a very, very important exemption. There are some modifications to that where the recipient of the gift is not a long-term UK resident and the donor is, but we don't need to go into that at this stage. Now, the tax-free allowance is £325,000. Now, whilst that might sound fairly generous, it hasn't actually moved since 2009. And somebody calculated that if we put that back into real terms in today's money, that would be equivalent of £500,000. So you can see the fact is that it's not particularly generous. And if you also bear in mind that it's going to be frozen until 2031, you can see the effect of the benefit of this is being eroded. Now, a very important relief to focus on is residence nil rate band. So essentially it enables you to pass on your interest in your home to your direct descendants, that's your children, grandchildren, and it enables you to benefit together with your transferable nil rate band. So your nil rate band, which is transferable, £325,000, that totals up to £500,000 between husband and wife and registered civil partners. That can give up to £1 million worth of tax exemption. So very important, but it has limits. The rate of tax on chargeable estates is 40%. It can be reduced where there are significant, as in 10% charitable donations actually involved, and goes down to 36%. We have these transferable allowances that I was referring to earlier, very, very important feature of tax planning in today's environment. Another very important thing to focus on is that lifetime gifts to individuals can benefit from what's called potential exemption. That basically means that if you make a gift, survive 7 years, there's no inheritance tax to pay. There may be other taxes that you have to take into account, such as capital gains tax, but that's part of the mix, part of the rich tapestry that we have to follow. Now, there's a strict anti-avoidance rule, which actually came back from the estate duty days a long, long time ago, called gifts with reservation of benefit. The net effect of that is if you make a gift subject to strings, then that property is going to be treated as taxable on your death. So you can't get away of making gifts of property and that property still not being taxed when you die. Numerous exemptions and reliefs. You have some exemptions that apply only in your lifetime, some exemptions apply only on death, and some exemptions can apply both on life and death. So it's relatively complex, but the unfortunate aspect is a number of those exemptions aren't particularly generous, and where they are, I'll make reference to them later. Now, the major change that we've got to take into account, which is going to feature in the final webinar, relates to the taxation of business property and agricultural property. Major changes here, major changes that are likely to catch people out unless they adopt a proactive approach to tax planning going forwards.
Inheritance tax sounds really complicated. Andrew, can you tell me how much revenue does inheritance tax raise?
Well, actually, it's really small if you look at the greater scheme of things. So if you look at the yield from national insurance, VAT, and income tax, that totals up 1,139 billion, so a huge amount of money, whereas the amount that was for 2024-5 as regards inheritance tax was only 8.2 billion. But the important thing here is it really does have an impact on people and their families. It's almost regarded as a point of social policy to ensure how easy it is to accrue wealth within our society. Now, if you look at the slide, because the slide indicates quite a number of interesting things. So Labour introduced transferable nil rate bands in 2007-8, and you can see, looking at the graph, that there was thereafter a dip in yield. Thereafter, it climbs quite rapidly until we get to 2017, which is when the Conservatives introduced the residence nil rate band, which I mentioned earlier. And then you can see as that was gradually introduced, the effect was to erode the tax yield. But we can see we're back to an upward trend at the moment. And that trend is likely to increase further simply because of the changes that have been made as regards the taxation of business property relief and agricultural property.
Okay, so who pays the tax, Andrew?
Well, again, that's really interesting. If you look at this graph, and all these graphs, they're not graphs that we produce, they're actually borrowed, if you like, from the National Statistics Office. So it's a government registered agency that produces this information. And you can see from this that, as you'd expect, as I said, that if you have the benefit of residence nil rate band and you have the benefit of the transferable nil rate band and you're a couple, you have a total of £1 million worth of allowances. So you can see the yield, if you like, the effective rate of tax is relatively low under the £1 million level. In fact, in some respects, it's a bit puzzling why there should be so much tax actually at that level, but can't really see beyond what the figures actually tell us. If you look after that, you've got a very interesting marginal rate of tax between 1 million and 2 million, which actually is the threshold, if you like, to the expiry of the residence nil rate band, and that expires at a level of in excess of 2 million and effectively ceases because it has a tapering effect at 2.35 million. and thereafter a rapid increase in the overall rate of tax, getting up to quite a relatively high level of between 20 and 25% when you get to the level of about £3 million plus, and thereafter it dips. Now, I think the effect of the dipping is actually as a result of the impact of business property relief and agricultural property relief, which, as we know, is now going to be changed or has been changed quite fundamentally going forward with the introduction of a 50% rate where the tax threshold of 2.5 million is exceeded. So I think we're going to actually see the level of tax actually increase in the future.
Okay, so does that mean the number of states paying inheritance tax are going up?
Yes, well, again, this is what this, again, thank you, the government, for providing this really interesting information. It actually shows the way that the yield is actually going up over the course of the last, let's say, 10 years. And you can actually see that there's been an increase, which has been going up. You also see another thing, which is actually quite interesting. It's called fiscal drag. Because if you remember, I said that the effect of the nil rate band not being increased since 2009 has had a profound effect. And that's going to continue into 2031. It's called fiscal drag because it has the effect of dragging people who wouldn't otherwise be within the charge to tax into tax. So it means that people who previously would be outside the scope are being drawn in simply because these exemptions, principally the nil rate band, hasn't been indexed as was promised originally.
Interesting. So, in summary, then, who needs to review their inheritance tax positions, Andrew?
Well, I think it's fair to say that those people who are particularly vulnerable are within the 1 million to £2 million category. Let's assume that they're married, they haven't used up their nil rate bands, and they've got a property which will benefit from residence nil rate band. That the benefit of those reliefs are eroding, but principally the residence nil rate band will expire as regards a married couple when the rate exceeds 2.7 million. So whatever you do in that particular area, and I think actually, Glenn, you've got a really interesting example coming through about pensions, which you can cover off, but it means that those people really do need to be careful about their tax position and is taking advantage of the regular reliefs that you've got. So, for example, I said there's some relatively straightforward reliefs. One, it's actually an exemption, not a relief. It's called normal gifts out of income exemption. So if you've got surplus income in simple terms, you can make gifts of that income without your standard of living actually suffering. Those gifts are exempt, and that's a really straightforward way of actually making gifts for grandchildren and children and so on. So the people in the category at risk between 1 and 2 million need to really be very careful. Thereafter, the people in the higher wealth levels also need to be careful. And actually, the people really who do need to be careful are those who've got business assets and agricultural property, because you can't make assumptions these days that you're going to necessarily get 100% relief simply because you've got a business. You've got to look at the structure of the business to ensure that it fully qualifies.
Okay, great. So I know we've covered off some of the changes that are causing concern. Is there anything further that you'd like to expand on that at all, Andrew? Do you think we've covered the really important stuff that everyone wants to hear?
Well, hopefully, yes. So
Okay. Yeah.
we've flagged up about business property and agricultural
Yeah.
property changes, very important, need to be examined very carefully. Requires proactive planning.
Yeah.
In the past, people often used to say, "But it doesn't matter, I'll get
Mm.
it 100% on death. I'll get a step up in value for capital gains tax purposes. I don't really need to look at it in any great detail." Positions completely changed now. We need to be much more proactive in what we're doing.
Yeah, and I know with obviously we talk about the relief and so on, but like you say, it's making sure that you actually get the relief, and things in your business can hinder that. So it's really taking action to look at those and review what you've got, isn't it, Andrew?
Well, it's actually really quite funny. It's quite perverse in a sense. Very, very successful family businesses have a tendency to accrue cash. They
Mm.
accumulate cash within the company. Cash accumulation can actually significantly restrict your access to business property relief going forwards. It's how you actually manage that cash accrual and make sure it's allocated for future business purposes. That's important.
Interesting. Such a fascinating topic, I find. So it's probably worth reminding ourselves as we move into the other side of things with Glenn. Let's talk about the pensions and how pensions are treated upon death and so on. So, Glenn, do you want to run through what you have coming forward?
Yeah, good afternoon, everybody. My name is Glenn Callow. I'm the Managing Director of Prime Wealth, and I am obviously talking to lots of clients at the moment about the changes related to IHT in general and specifically to pensions. They were announced in October 2024, and it certainly caught the industry off guard and sent everybody to consider their affairs and what actions they might want to take now or in the future. I think it's important just before we start to just touch on what is and isn't affected by the IHT rules. So any ongoing income payments from defined benefit schemes, either to yourself or your spouse, are not included. However, any lump sum death benefits from DB schemes would be. So what is exactly subject to IHT? And what we're talking about today really is money purchase schemes or defined contribution schemes. So personal pension funds as they're being left to the next generation. To a spouse, like Andrew has already commented, exemptions are there. So it really is the second death issue that we are looking at in the case of married couples. There's a complexity around the valuing of annuity guarantee periods that might be paid to the next generation, which is probably outside the scope of today's discussion.
Great. So, do you want to just talk us through the evolution of the pension succession tax?
Yeah, indeed. I think it's quite interesting to see because it's a very emotive subject and people are reacting and will be taking action and rightly so. But if you look at the history of the succession taxes on pensions, prior to 2011, total highest tax payable was 82%. We saw that drop down between 2011 and 2015 to a rate of 55%. And then we found ourselves in the era that we are in now, which is the kind of pension freedoms era. That was the kind of the statement of pensioners going to be stripping their pensions and no caps on what you can withdraw and buying Lamborghinis. And I haven't seen too much of that, to be quite honest. Really, for two reasons. First of all, over and above the tax-free cash, you have to pay income tax on what you draw out of your pension. And secondly, very generous succession taxes. So you can see here that those taxes have dropped down to 0% if you passed away prior to 75, and there's an income tax in the hands of the beneficiaries if you pass away post 75. So I'm going to talk about that in a bit more detail in a second with some real world examples. And also you can see now the regime we're moving into, assuming all the legislation goes ahead, would be 40% inheritance tax plus income tax, which has that kind of punitive rate, which is quite alarming.
Wow.
So is it all about inheritance tax? I'm not so sure it is, to be honest. It's also about, I think, behaviour change. I think they're trying to encourage wealthy and individual pension owners to not leave their pots untouched, which is what the tax treatment of the pension freedoms era encourage people to do. So you spend your non-pension assets, which are subject to IHT, and leave your pension to the next generation. So they're trying to impact that, which in turn encourages people to potentially draw on their pensions outside of their tax-free cash. So you pay income tax. And in some instances, you might pay both.
Great. So let's move on to the next scenario then. Talk us through the pre-April and post-April stuff.
So here we are. So we're pre-April 2027. So this is a pension fund that is being left to the next generation. So prior to if I'm less than 75, there's no inheritance tax charged on that pension. The beneficiaries can withdraw that without any income tax whatsoever. So incredibly generous. Or they could leave it in the pension pot and it can grow income tax and capital gains tax free to be drawn upon in the future, again, without any further taxes. So incredibly generous, almost like a tax-free family trust. And they've been used as a wealth transfer vehicle for that reason. So again, pre-April next year, but post the age of 75, the rules as they stand, there's no inheritance tax. That's not coming until April, but beneficiaries would be subject to income tax when they withdraw. So if they were to draw that out, then either if it was in their personal allowance, they'd pay a nil rate. At base rate, it'd be 20%. Higher rate, it'd be 40%, and obviously additional rate taxpayers at 45%. But there's no compulsion to withdraw. They could receive the pot and just draw on it at a point in the future and defer any tax on the investment of those assets.
Okay. So how's that changing?
Okay, so from April 2027 and death prior to the age of 75, again, this is not to the spouse, but to the next generation, inheritance tax now applies at a rate of 40%. The beneficiaries can withdraw the pot following that free of any income tax. So you've still got this kind of cliff edge at the age of 75. So that's quite prominent, as you can imagine, the advice that we're providing to our clients, some of those with maybe shorter life expectancies, it's certainly a key consideration. Post the age of 75 is where it gets really quite uncomfortable. So we have inheritance tax that applies at 40%. And then you have the beneficiaries who'd be subject to income tax on the remaining pot. There's no double taxation. So this is now tax on the 60% that's remaining, again, at their marginal rates. So if they're nil within their personal allowance, that would be nil, 20% for a basic rate, 40% for a higher, and 45% for an additional taxpayer. So you can see really, you do often see in the press that headline number quoted, which is 67%, and that's a function of the 40% inheritance tax followed by a 45% income taxpayer withdrawing that pot following their inheritance.
Wow, there's some big changes coming. Let's have a look at some real world numbers, Glenn, because let's see it in that perspective of how it can really impact someone.
Yeah, I think it really does bring it home when you see this is a real life client scenario of ours, obviously anonymized and slightly rounded for convenience. But if I just talk through the calculation with you, just to try and bring this to light, particularly around the loss of the residence nil rate band. So we have a client in this scenario, they're a married couple, they've got a property valued at £1 million and cash and investments at 700,000. They've saved frugally and built up a pension pot of £1,050,000 during their lifetime. So the estate subject to inheritance tax is £1,700,000 because the million or so value of pension is not included as it stands. How the calculation would work is they both have £325,000 nil rate bands available to them, as Andrew was saying. So the 2 times 325 is your 650. And then the residence nil rate bands are available to them as well. So a further £350,000. That's £1 million in total allowances. So of the 1.7, £700,000 is subject to inheritance tax. So IHT, if death were to happen today, at 280,000. So it's a problem and something to be aware of and considered, but clients in their mid-60s, long life expectancies ahead, lifestyles to fund, it's not necessarily going to dictate how aggressively that you act. If we fast track to 2027, April next year, you add the pension back in, you've now got a combined estate of 2.75 million. The residence nil rate bands are now tapered, so you've still got your nil rate bands, of £650,000, which you can use and exempt from IHT, but the 350 residence nil rate bands have fell away. So you've now got an estate subject to inheritance tax of £2.1 million. 40% on that is £840,000. So that's a £560,000 increase. So it's really significant when you factor in that as an effective rate of 53%. If you go further, and I'll just extend this example a little bit further because it is a pretty cruel scenario and one that we do see quite regularly. That pension that was a value of 1,050,000, which was outside the scope of inheritance tax, is now going to lose 40% to inheritance tax, which takes it down to 630,000. Assuming the beneficiaries of that pot of 40% or higher rate income taxpayers, they pay a further 40%, which nets it down to 378,000. And if you add in the effect of the loss of the nil rate bands, which effectively is another £140,000 of tax costs, you add all of that up, and if that was just solely burdened on the pension, then you've got 1,050,000 is actually reduced to 238,000. So you can see why people are considering their affairs and what their approach might be over the coming months and years.
Yeah, I think to see that on paper, it's eye-watering to see how much you potentially lose just with the sake of a rule change. What's the best approach for clients who are concerned about this?
Yeah, and I think it's really important to kind of pause for thought. It's a very different scenario for different clients, even with identical wealth. We certainly want you to understand your exposure initially. So hopefully our comments today, myself and Andrew have gone some way to inform you and help you understand your exposure. I think personalised advice is absolutely crucial. Larger estates, so those with businesses and pension wealth, are very significantly impacted, so meaningful change there. And I think the combination of regulated tax advice and regulated financial planning together really does ensure you have the best outcome.
Absolutely, couldn't agree more.
And so quite often myself and Andrew are meeting clients. We're in the same meetings at the same time with a joined up approach, which really does help the client rather than running from tax advisor to IFA to other advisors and just getting thoroughly confused in the process. Like I say, it's a highly personalized solution. It's going to be based on our client's wealth, lifestyle needs. What are we funding? You can give it all away, but how are you going to live over the coming years? And we do a lot of cash flow modeling to help clients understand that. What are the family dynamics? It's one thing to say we'll give it away, but are those recipients or potential recipients in a place where they could be receiving and should be receiving such large sums? And individual preferences, we're all different. We all have different views as to how we might want to approach this. And of course, health, as I said, that kind of cliff edge around the age of 75 is quite a key influencing factor when we're building advice solutions for our clients.
Yeah, I think it just highlights the importance of how personalised inheritance tax planning is. So we've come to the end of the talking, if you like. Please do put any questions that you might have in the Q&A. I do have some questions for the speakers, which I'm going to put to them now. So let's run through a couple of those and see what we can cover off. So I think the first one I kind of want to ask is, Andrew, what's the major issue at the moment with family businesses that you're seeing?
The major issues is that people need to change the way that they think. In the past, it was almost accepted wisdom that the patriarch or matriarch of the family would hang on to let's say, the shares in the family business. They would benefit in full from business property relief, let's say, and get a step up in value for capital gains tax, because when a person dies, there's no capital gains tax charge, but the asset value is rebased to its market value at the date of death. So that's the sort of mindset that people got into. And the trouble is, you can't do that anymore. It's actually a much more dynamic process, because your allowances, as regards business property relief, it's £2.5 million that you can give away and benefit from 100% relief. And where there's husband and wife, that could be 5 million. But it actually means you've got to be doing things on a regular basis if you want to make sure that the family wealth is protected and transferred. You can't actually just leave it right to the end of the process. So that's one of the major impacts. People have to change the way that they think about doing their planning.
And I think that's what we see, certainly in the advice that we're providing. It's inheritance tax planning isn't a one and done. It's not an extreme example, an extreme step to take at this point in time. It's really something that evolves over time. And the first step is understanding your exposure, what you're prepared to do in your 60s and early 70s will be less than what you might be prepared to do in when you're 75 and 80 and 85, because you're further down the track and your lifestyle needs and requirements are much better understood, and so you can plan and take actions such as gifting or rearranging assets with a bit more confidence. But it's just trying to strike that balance, isn't it, Andrew? Really,
It's striking that balance, but equally fair. You need to ensure that senior members of the family have sufficient wealth to actually live on and enjoy their retirement.
Exactly that.
Which is one of the aspects that we talk about with clients.
It is. When we're looking at clients' financial plans, we're building full cash flow models so we can understand what it takes to keep the lights on, what it takes to replace the cars, what it takes to go on the holidays that we want to take, to really understand that and map that out over the future before you start saying, well, let's just give very large sums away and hope that we'll be okay.
Yeah.
I think
Interesting. I do have a question for you, Glenn, that's come through on the Q&A. What's the thoughts on whole life insurance to cover predicted inheritance tax?
Yeah, I mean, it's absolutely one of the tools. I think if clients are in good health, certainly, so obviously these policies are underwritten. So a whole of life policy, for those that aren't aware, is an insurance policy, typically that is taken out to provide a lump sum to provide for the inheritance tax liability as and when it were to come. It's typically written on a joint life second death basis. So I write it with myself and my wife for the whole of our lives. It can also be written on single life for unmarried people, but it's written for the whole of our lives. And we say, well, actually, our IHT liability is $1 million or whatever that figure that might be. I don't want to do any other planning. I don't want to give anything away, or it might be property asset rich, which I can't. There's implications of giving those assets away. I'll get an insurance plan. I'll pay a monthly premium, which pays a large lump sum out in the event outside the scope of inheritance tax in the event of our demise. So it does work very well, and it can be a very much the kind of the path of least resistance. But the pricing, someone's age, someone's state of health is very, very key there, along with their ability to maintain those premiums, because the premiums can be quite significant, and it is a whole of life contract, which if you let lapse, then effectively the whole value has been lost. So it's one of the tools available to clients, and we've got a number of modelers which seek to kind of express the value of those policies. Really, when you look at, okay, well, these are the premiums going in, this is the sum assured coming out, we don't know the other bit, which is how long we're going to live. Let's use some modeling to try and understand the real value of that, and if that makes sense.
Okay. Glenn, can you just share your screen just for a moment, and I'll cover off some more of these questions as well, and then we can see you all fully as we go through them. I do have another one for you, Glenn, which is just a brief summary. Someone's just asked, can you just explain the impact on the pension pot changes before and after April 27 again that you mentioned in your webinar, just to cover it off?
Yeah, I can do. I'll just close the slide. Would have been out with the slides.
So in general terms,
the key issue there really is, so pre the age of 75, let's ignore inheritance tax for a second. Pre the age of 75, if I pass away, the beneficiaries can draw out that pot free of any income tax. If I, the pension member, am over the age of 75, when they draw that pension, they will pay income tax. So then you double that with the fact that there'll be inheritance tax from April 27, and I'm over the age of 75, you've got the inheritance tax hit, and then you've got the income tax hit in the hands of the beneficiaries. So hopefully that clarifies that point for you.
That's great, thank you. I've got a really interesting one, which I'm going to direct this one to you, Andrew. Someone's asked, at what point in life should I start my IHT planning? Is it now in my 50s or later on in life? And I think that's a great question, because many people think about it. So
I think the answer is you need to start as soon as kind of it is right for you. So it's often during your life you're accumulating wealth, you're looking after your family if you have one, and so on and so forth. But you'll come to a time when you might say to yourself, I've actually got enough for me. and I would like to be in a position to benefit my children, my grandchildren, or whatever. It could be charity, for example. When you get to that stage, I think it's really important to set up a strategy going forward as what you've got to do. A lot of constituent elements in there. So, for example, it's important to have a will that is going to work to give you that sort of freedom, if you like, and security, to set up trust if that works for you. The other way of looking at, depending on the type of assets you've got, is using family investment companies. Very, very popular now, a lot more advantageous in some respects as than they were in the past, and may be useful as a form of trust substitute when you're dealing with shares in a private trading company, because you do a reorganization to make sure you had a different form of company, the family investment company, owning those shares. We've seen quite a lot of interest with our clients about that as a structure. But I think, to cut a long story short, I think it's when it's right for you to actually start that journey, and we'd be very happy to accompany you on that journey together with Glenn.
Yeah, I think we do see is on those for younger clients, they might say, well, a whole of life policy and that whole of life commitment is reasonably expensive given our other outgoings and family requirements, etc. And we're not quite ready for that step. But you might see clients take out their policy to the age of 75. Much cheaper, low value, low cost premiums, which it does extinguish at 75. So it's not ideal for inheritance tax, but it might be that kind of halfway house between doing nothing and then if the worst were to happen, you've got that significant exposure to something that's affordable and just feels manageable right now.
Yeah, it's that tailored approach again, isn't it? And it's not one size that fits all, but it's something that people should have in the back of mind and think about it, like Andrew says, when it's right for them and it's the time's right to look at it. I've got another question. So it could be for both of you, really. So how effective can trust be to minimise IHT?
In terms of, I'll take that.
Yeah.
It depends. The advantage of trust are they're incredibly flexible in terms of planning. So they, as a general rule, you should have your life policies actually settled in trust, so they accrue outside your estate when you die. So that's a simple form of trust. For people with wills, there should generally be residuary trust, which actually looks after their wealth, a form of discretionary trust to maximize flexibility. But also, very importantly, as regards business asset protection for inheritance tax purposes and agricultural property planning, they're a key constituent element of actually protecting the next generation. So I'd say they are very, very important.
Yeah, it can be a great option, can't they? Just to cover off a couple of other ones then. So, Andrew, are there any IHT reliefs that you see people aren't making the most of at present?
Well, funnily enough, I touched upon it in the presentation. I was talking about normal gifts out of income. It's not so much relief, it's an exemption. Exemptions are great because actually that's total absolution, if you like, from a liability to inheritance tax. And it's making sure that you set it up in a way that maximizes your relief. So, for example, normal gifts out of income, you have to have habitual gifts, and you have to ensure that you use your normal income, which isn't required for your standard of living. But you can make it very flexible. You could have a memorandum which says, I intend to give 10%, let's say, of my net disposable income to people within a certain category. Now, it doesn't mean to say you have to make gifts the same amount each year. You could make a gift of all of your income, let's say, to one of those people within that category. So it's a very, very flexible form of relief. And if you want to take an asset test, there was talk about 2 to 3 years ago of abolishing normal gifts out of income. So I work on the basis that if they want to stop it, it generally means that it's good news.
That's a good point, isn't it?
I'll just add to that, really, Paisley, that we do see, and this is tread carefully and not without
Yeah.
advice, but we do see where we're seeing clients withdrawn their pensions to create additional income, which is additional excess income, as long as it's done
Okay.
carefully and habitually and with routine and
Yeah.
the items that
Yeah.
we really need to be very, very robust with, to create additional income and then create an additional excess and then give
Wow.
away, which is immediately exempt. So yeah.
It's interesting, isn't it, when you think about it like that? But it's, I guess, with any types of things, it's all in the record keeping as well, and talking to us as advisors to make sure you are able to track it and do all of those types of things to make sure it's the right thing for you.
Absolutely.
Okay, so if we've got the scenario then, someone with a business that's less than just less than £2 million in value, but they're married, should they be reviewing their inheritance tax position?
I personally would. I understand fully that the limit is 2.5 million per person.
Yeah.
For a married couple, it would be 5 million. But you're making a huge assumption there that your business does actually qualify in full for business property relief. And if you remember, I was saying earlier that successful businesses often accrue significant amount of income, and sometimes they accrue investments actually within the business. You need to ensure that it actually does qualify for business property relief from the beginning.
So
Because
it's not just about that number, is it? It's about making sure you're ticking all of the boxes to
yeah,
ensure you can get the relief in full.
yes, I couldn't agree more.
Yeah.
Absolutely.
No, great. No, I've got an interesting one. So, do you thoughts on if in the next elections, if the government was to change, do you think any of these rules might change at all? Do you think they're here to stay?
That's a
Good
hostage.
question. Good question.
Yeah, it's been recorded. This is, isn't
it? Let's think. Like, these rules have been introduced, haven't they, for trusts from April 26. You've got the pension changes coming in from April 27, and whilst that's not legislated yet, it's on its way to be legislated. Is it unlikely that they're around to stay?
Well, you may find that different political parties have different stances, which is understandable. But I think the other thing to recognise is that there is a shortfall in revenue within our society, and whether that is for building up the armed forces or for social spending. So it's relatively unlikely that tax yield is going to be reduced.
Yeah, I think I'd agree with that. We can't say what a future government might do. I think, but there is, for clients with many years of life left ahead of them, there's certainly a pause for thought. And how aggressive do you want to be when you're not certain of what the rules might be in the future? And certainly we've been encouraging clients to be quite conservative in how aggressive they are, particularly where they're triggering high levels of income tax to put assets in their estate outside their pension, and then reliant on contingent planning like surviving 7 years or something like that. So I think it's I think it's a word of caution. None of us know what the future will hold.
Yeah. And I think just with the key around that is, don't wait for that to happen. You need to think about what you're doing now. You can't rely on something changing, can you? You never know. If it's here to stay, you need to start planning and thinking and speaking to your advisors.
Certainly the economy seems to require some tax revenue.
Yeah. I've just had one more come in that just basically says, I think we're coming to the end of the webinar now, so I'll just cover this one off. With the new pension rules coming in from 2027, they're just saying the passing of your pension is still tax-free to your spouse. So there's no change there, is there, Glenn?
Spousal exemption still applies, yeah,
that's fine.
From an inheritance tax perspective,
yeah, great. So I think we're coming up to our end of our webinar, and just want to thank everybody for attending. If you need any questions answering, or you want to reach out to any of us, please feel free to drop us a message. As I say, this was the first webinar in a 3-part series. We will be releasing the dates in the coming weeks for the next session, which is hopefully in the next month's time. So watch out on your emails for the next invite. And as I said, this is recorded as well, so we can circulate any recordings to anyone that couldn't attend or wants to watch back at a later date.
That next session, Paisley, will be covering off real world practical planning opportunities, really. So we want to cover the rules today, and then we'll get into the ways of what people can do.
Great. No, it'll be great to demonstrate it all to people. So yeah, thank you everybody for attending, and we'll see you at our next webinar.
Yes, thank you.
Thanks for your time, everyone. Thank you.